Hi, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in this video, we're discussing the potential tax implications that come with taking early Social Security benefits and strategies to maximize that impact.
Yeah, this is an important topic because choosing to claim Social Security benefits early is very popular right now.
Yeah.
And I get that taking early Social Security benefits can provide financial relief for individuals in specific situations. But people need to understand the potential tax implications of taking these early Social Security and that a portion of their monthly payments may be subject to federal income tax. I say may because it doesn't apply to everyone.
No, it doesn't. But in some cases, people have to pay state income tax on it as well.
Yeah, that's right. Currently, 12 states also tax Social Security benefits. But for the purpose of this video, we're just going to focus on the federal taxes.
All right, well, then let's start with how Social Security benefits are taxed.
Yeah, how the IRS calculates what's taxable in your Social Security benefits is based on what's called your combined income, also called provisional income.
Okay.
So, provisional income is the level of income that's used to determine whether you owe taxes on your Social Security benefits. And there is a specific formula for calculating this. What you need to do is take your total adjusted gross income or your taxable income plus tax exempt interest, such as municipal bond interest, and plus anything that you have coming out of your retirement accounts that are tax deferred, plus 50% of your annual Social Security benefits. This number equals how much you're going to be taxed on.
Okay, so can we walk through each of these? Let's start with what's taxable.
Okay. First, what would be taxable is like earned income from your job, any rental income, capital gains, whether they're short or long term, and any type of investments that you may have.
Okay.
Also, let's go to the retirement accounts. Anything that you take out of your retirement accounts that were tax deferred, like 401ks, 403bs, 457 plans, traditional IRAs, or even thrift savings plans.
Okay.
These are retirement accounts that are tax deferred, meaning you paid into them, you got a tax break, and now you're looking to take out that money in the form of a required minimum distribution.
Mhm.
You're going to be taxed as ordinary income. If your provisional income exceeds these thresholds, a portion of your benefits will be taxed up to the federal income tax limits.
Okay, so walk us through the current thresholds for provisional income.
Okay. And this is broke down between single and like married filing joint. So let's start with just single filers.
Absolutely.
If your provisional income is below $25,000, Social Security benefits are not subject to generally not subject to federal income tax. Got to put that word in it. But if your provisional income is between 25,000 and 34,000, up to 50% of your Social Security benefits may be taxable. And it's above 34,000, up to 85% of your Social Security benefits may be taxable. That's the highest you can go to, up to 85%. So, and now, if you're filing jointly and your provisional income is below 32,000, usually you're not going to be subject to federal income taxes. Between 32,000 and 44,000, up to 50% of your Social Security benefits are taxable. And it's above 44,000, up to 85% of your benefits are taxable.
Okay, Brian, I have a quick question here just for clarification. So you fill out the formula that you gave us earlier, right? You get that number, and these are the thresholds. So what you're telling me, let's say that I am single and my provisional income is above $34,000.
Right.
I'm going to be taxed up to 85% on my Social Security benefits. Now, I've already paid taxes on all this. I mean, this is the money that I've already paid into the system. So you're getting taxed again?
Yes. And here's what where it says up to 85% of your Social Security benefits may be taxable.
Sure.
Okay. So let's say, Michelle, that you received early Social Security benefits of $10,000 for this tax year. Okay. Or last tax year. You had your 34,000 of income, up to 85% of your Social Security benefits may be taxable. So what happens is out of that 10,000, 8,500 or 85% will then go on to your taxable income for the year. So then that gets added up with the rest of your income, like we talked about, and then you pay taxes on that whole amount.
Woof. Okay.
Yes.
All right. So here's the thing. We're going to drop the 2023 Social Security fact sheet in the description below. Go check that out. But Brian has made a video where he walks you through exactly how to fill out the worksheet to figure out what your tax implications are for any given year. So again, that video and the Social Security fact sheet PDF will be in the description below and in the pinned comment. So
exactly
check that out when this video is over. All right, Brian, let's get to the most important thing. After we're all breathing and figure out how much taxes we owe, what are some strategies to minimize the tax impact?
Yeah, we're talking about early Social Security here, and a lot of
Sure.
people who take it are still working, right? So ideally, you would take into consideration your taxes before you claim for early benefits because decreasing your income is the best way to minimize taxes.
Yeah, it
Okay.
is.
Managing other income sources is also a good strategy to minimize the tax impact. Quick note here, if you're an early Social Security filer, don't forget the penalties for working while collecting early Social Security benefits. From age 62 up to the year you reach full retirement age, your earnings limit for this year, 2023, is $21,240. For every $2 you earn over this limit, your benefits are going to be reduced by $1.
Yeah.
You need to carefully consider your other sources of income and their tax implications.
Yeah.
Adjusting your adjusted gross income, AGI, by taking all allowed deductions, whether it's standard deductions or itemized deductions on your tax forms each year, and take advantage of tax efficient investment strategies like dividends, which are usually taxed as a lower rate than
Yeah. Low
ordinary
rate.
income.
Yeah.
Huge difference. Or even capital gains that are taxed at a lower or possibly higher rate, depending on your holding period.
Sure. But
All this can help.
long-term capital gains typically
Right.
is lower rate.
And
Yeah.
all this can help you lower your provisional income.
Yeah.
Another strategy, Michelle, is timing. And here's what I mean by this. Timing can play a crucial role in managing your tax liability.
Yeah.
You've got to plan and time things out ahead of time.
Ahead of time. Right.
So, for example, you need to plan when you're going to withdraw from your retirement accounts. Taking out too much from the wrong accounts could tax up to 85% of your Social Security benefits. So, being able to, this goes back to one of my favorite things, being able to withdraw from Roth accounts first could increase your income without incurring additional taxes. If you
Right.
still need more income, then withdraw from your taxable accounts next.
Okay. All right. So what other strategies are there to minimize the tax impact?
Honestly, Michelle, the third strategy is to seek professional advice.
Absolutely. I was going to say this is a lot.
This is very complicated. I highly recommend you consult with a qualified tax professional, CPA, or a financial advisor when navigating the tax complexities
Sure.
associated with early Social Security benefits. And here's why: they can provide personalized guidance based on your specific circumstances and help you make a more informed decision.
All right. One quick question here. One final question.
Mhm.
At what point should people seek professional advice? Do you think like 5 years before retirement? Because a lot of this, as you said, if you take early Social Security benefits and you're still working, I mean, that right there, you're going to pay taxes on Social Security most likely. Like at what point, how far in advance should someone get help?
Let's put it this way: do you ever go to a doctor and sometimes you just question what that doctor's saying, and maybe I should get a second opinion?
You know?
Well, think about that every time you make a thought or make a decision where you say, you know what, I think I'm going to retire early. Okay, I'm going to take early Social Security benefits.
Get a
I'm
second
going to do
opinion.
this. I'm going to do that. Go and seek a professional opinion and let them understand what you're trying to do and maybe help you through that process. Because in all honesty, Michelle, I'll tell you, in my 25 years as an advisor, I've had people come to me and say, look, I'm taking early Social Security. And before I even go into any numbers or anything like that, first thing I ask them is, what's your plan B for healthcare from 62 to the age 65
65.
until Medicare kicks in?
Right.
And you know what? They don't have one. So I hop on healthcare.gov and run them a quote of what their healthcare is going to cost them. And guess
Yeah.
what? They stay working for
Sure.
3 more years.
Okay.
So as soon as you think you're thinking about doing something, make that decision to seek out professional help.
Sure.
Even look, there's so many people that would just sit down with you without charging you a fee
Yeah.
to give you at least some advice of if this makes sense or not for you.
So qualified tax professional, financial advisor, or do your own
You got it.
research. I mean, that's the thing too. You can do all your own research and then go to this person and say, look, this
Yeah,
is what I want to do for these reasons.
here's what I want to do. Right.
Again, we're going to drop a link in the pinned comment and description below on a video that Brian did where he walks you through filling out the Social Security benefits worksheet to determine the potential taxes that you could pay, whether you're married or you're single. And also, we're going to drop in the fact worksheet from ssa.gov in the description below. Go check that out next. It's really, really important. I hope that you understand how important it is to plan for these taxes. Otherwise, it's going to be a nasty wake up call. So,
Yeah, we don't want to plan after the fact. So
nope, no. If you found the content of this video helpful, hit that like button, help us grow this channel, leave us comments below, and don't forget to subscribe. All right, Brian, thanks for this, and thanks to everyone who watched.
Thanks, everyone. Have a great day.